Welcome everyone to Values at Risk 2025. I'm Mark Tracy, Professor of Sustainable Finance and Investing here at the Institute at Brown for Environment and Society, or IBES. Welcome back to some of you who may have been in our Values at Risk last year, which was a very timely webinar and an ongoing series on this very important topic, of the intersection of financial risk and nature and climate. I'm going to pass it back over to Ricardo to introduce our panelists, but just quickly, also want to make you aware of an exciting event that's upcoming. We're going to be having next semester Brown's first ever Climate Week. It's going to be March 2nd through the 7th. We have six days of ideas, inspiration, and action on climate and sustainability. Led by IBES with partners across campus. Climate Week's going to spotlight how Brown students, faculty, and alumni are driving real-world solutions to these problems. Events will include a marquee keynote speaker that will announce shortly the Climate Career Fair, Banking on Nature, Sustainable Finance Conference, and a number of other events. Together we'll celebrate collaboration, spark new connections, and highlight Brown's growing leadership in climate and sustainability. Please let us know if you'd like to participate in any of those events. And with that, I want to introduce formally Ricardo, who is a professor here at IBES, who leads the very popular Finance the Environment class, and also a founder of Encourage Capital. So Ricardo, take it away.
Thank you, Mark, and welcome again, everyone. As Mark says, I'm a professor. I teach two classes at Brown. One of them is called Values at Risk, basically about the topic we are going to be discussing and about the importance of risk and how risk is dealt with in the financial system and how climate and environmental issues may be upending that whole concept. So I am delighted to have with us a stellar panel. Sadly, we've lost Carolyn Kowski to illness. She won't be joining us, but I'm sure between Alyssa, Nuin-Tara, and Guillermo and I, we can try and channel some of the concepts that she would bring. Before we get started, and before I ask the panelists to introduce themselves, I just wanted to say a few words about why we're talking about risk and about the importance of talking about risk. It seems in many ways like a bit of an academic subject, but it really is not. In finance, there are really two human emotions that drive all kinds of investments. They are greed and fear. And in the financial world, we call greed returns. And in the financial world, we call fear risk. And risk determines whether you make an investment or not make an investment, just as much as greed or return determines whether you make an investment or don't make an investment. And if anything, the last 20 to 50 years in the world of finance has been about coming to better understandings of risk, coming to different techniques for measuring and adapting to risk, and trying to understand how to make investments based on risk. And I think what we're seeing now with climate change, with environmental degradation, with impacts on biodiversity, and the impacts that climate and environmental issues have on all aspects of our economy, from supply chains to insurance to everything else, I think those are upending some of the thinking about risk. And why do I say that? I say that because I think in many ways, the way we have dealt with risk has been backwards looking, probabilistic and backwards looking. We say, what has happened in the past? How many, earthquakes, fires, what have you, have happened in the past? And it's a little bit like driving in the rearview mirror. It has worked to some degree until now, but I think in many ways the future does not look a lot like the past because of climate change, because of environmental issues. And all you have to do is look at what happened this year in Los Angeles, one of the biggest, most costly disasters in US history and probably in global history, with the LA wildfires, costing anywhere from, depending on who you ask, $100 billion to $300 billion in damages. And the impact that has on the economy, not just the California economy or the LA economy, but the global economy is huge. And the impact it has on insurance and insurers is huge. And, while we may say, and we may all say, what, who cares what happens to insurance? We should all care, really. Because insurance allows us to make investments. Insurance protects investments, and insurance lowers that fear risk to allow people to invest in things that we want. And if we can't get insurance, then a lot of things changes. So for instance, if you think of the biggest asset in the world, real estate, um, a lot of that value is driven by insurance. When you can't get insurance, values drop. And we've seen that in Los Angeles and Florida. And if you think it's just about California and Florida, you'd be wrong, because some of the biggest problems in insurance in this country are happening in the middle of the country through things like convective storms and hail and wind and rain. So insurance is becoming a problem in the Midwest, not just in California, not just in Florida. And in places where it is a problem, well, mortgages rely on insurance. If you don't have insurance, you can't get a mortgage. So what will happen if insurance really suffers? And not only that, insurance are probably the second or third largest institutional investors in the world. So all the money from your premiums is invested. And that is somewhere on the order of 40 to 60 trillion dollars globally. Um, what happens if that money starts to dry up and investment starts to dry up? So I guess what I'm getting at is that these are not just small risks. They're not just risks to one industry. They're actually systemic risks. So they are risks that impact all aspects of finance and will hit every aspect of our economic life, from insurance, from real estate, through to business, through to supply chains. Because what happens if you can't, get agriculture, you can't get cocoa because of climate change or drought or what have you? What happens to chocolate markets and coffee markets? Heaven forbid, we rely on that to get up in the morning. What happens to those markets? So just to set the context, this is big. How we think about risk and how we manage risk is huge. And we have with us a stellar panel to try and address and dig deep into this. So I'm going to ask them to introduce themselves, and I will start with Elisa Valderrama, and then Guillermo, and then Nuin-Tara. Elisa.
Thank you so much, Ricardo. Ricardo is an old and good friend, someone I looked up to my whole career. So always excited to participate in these panels. Briefly about myself, my name is Elisa Valderrama, co-founder and co-CEO of Future Proof Technologies. We are starting a property insurance company built from the ground up around principles of AI and climate resilience. So we've built some unique tools for pricing catastrophe exposed property insurance, and we're now essentially eating our own cooking, using our tools to price and underwrite risk, particularly for small commercial property and single family residences. I'm an attorney by background and worked on sort of environmental project finance and infrastructure project finance for about 10 years before starting Future Proof.
And Elisa is one of the smartest people on all things environmental and now insurance, and creating a startup in fintech, which is absolutely necessary and very, very brave in the world we live in. But without it, I have very little hope for the future. So let's hope she succeeds. Guillermo, over to you.
Thank you, Ricardo, for the invitation. Always a pleasure. My name is Guillermo Franco. I'm a managing director and head of catastrophe risk research at Guy Carpenter. We are a reinsurance broker, part of the Marsh McLennan companies. I've been at the company for about 14 years, and I've led many of our research initiatives, and in particular now I'm leading our research and development in parametric insurance efforts. We've transferred about $6 billion in limit using new parametric policies and contracts. So I think this is a bright spot of our industry. I'm an engineer by training, originally from Spain, did my graduate studies in New York at Columbia University, and met Ricardo through our common collaborations with University of California, Santa Cruz. And it's a pleasure to be here.
Thank you, Guillermo, and really somebody who has a depth of knowledge into not just traditional insurance and how it works, but where the insurance industry is headed, and with things like parametric insurance, which we'll discuss and explain a little later on, but also insurance-linked securities and other new approaches to insurance coming out. Nuin-Tara, over to you.
Wonderful. Well, thank you so much for the invitation to be here. I'm Nuin-Tara. I'm Executive Director of Programs at an organization based in California, California Forward. We are a statewide organization that really works to build a new California economy, one that is sustainable, resilient, and inclusive. And for that, a couple things that are key priorities for us. One is recognizing that anything we are doing on the economy has to incorporate climate, both as a macroeconomic issue as we think about energy transition and some of the industrial policy and work that needs to happen to reduce emissions, and really guide kind of our economy to a new climate future, but then also really recognizing, and we will talk about this a lot here today, around climate risk and the impacts of a changing climate as an economic and fiscal issue, and really thinking about how do we really manage climate risk as an economic issue at hand, as well as health, safety, livelihood, and many other dimensions of it. We also in California, just given the role of this state, recognize that there is not a one-size-fits-all approach on economic development generally, and that anything we're doing on the economy in California really needs to take into consideration kind of regional differences and regional economies. In California, many of our regions are larger than some states, and states combined, and actually it is in the regions where our economy is happening. And that also comes into play as we think about how we're managing the different dimensions of climate as they're showing up in economic and fiscal issues across the state. I have a background in urban and regional planning, but have spent the last nearly 2 decades working at the intersection of public policy and climate, worked in public sector, but then also went over to an insurance company for a bit too. So increasingly working on climate finance, and thrilled to be here today.
Yeah, Nuin-Tara, you have one of the most holistic visions of how insurance and public policy play out. And I think I'd love to start with you deepening into this connection between climate, environmental risk, insurance, and economy, and just really think about how that impact happens. And you with Carolyn Kowski from who created Insurance for Good and was going to be with us today, but sadly got sick. You've created this process to look at not just insurance, but resilience and adaptation and how we face up to some of these risks. So I'd love for you to talk a bit about that. But let's start with the importance of this subject and why a nonprofit like California Forward is thinking about and looking at insurance and climate risk, and how that interplays with policy. Because one thing a lot of people don't really understand is that, take the LA wildfires, whatever your number, whether it was $100 billion or $250 billion in losses, only 40% of that, maybe 50% of it was insured. So the other half of it was paid out by people, by others, and ultimately to some degree by government. So in a way, if insurance isn't there, government is left holding the bag. Insurers write 1-year contracts. After 1 year, they can say, no more, I don't want to do this anymore. Government can't walk away from these catastrophes. So how do you think all of these issues will impact not just economy, but policy and politics in this country?
Yeah, I so appreciate that framing, and I will just start here by kind of double clicking or re-emphasizing a couple points that you've made and kind of dig in from there. One is that I think really at the foundation of how we grapple with what it means to live in a world of ever increasing risk is that we have to be managing risk as a financial and an economic issue. And I will talk a little bit more about that. The second is, and this gets a little bit to your point of, kind of who owns what risk over what time period is we have to mature how we're thinking about risk ownership. And then the third point that I think kind of brings the pieces together and also highlights some of the things that you were talking about of the role of insurance is we need to also realign and think about how we're realigning our economic incentives to reinforce the value of investing in risk reduction. Because I think the bottom line here for us and in this space is we cannot financially engineer our way out of this climate risk challenge. What we have to do is physically change the risk conditions on the ground. There is no sustainable insurance market in California or nationally if we aren't actually making strategic investments to lower the physical risks on the ground, which is ever challenging. The more and more emissions that we release, the harder it gets. And I think from a policy and also kind of a political support perspective, there are things that we can do, and we need to communicate that actually we do have the ability to reduce kind of physical risk on the ground to wildfires, to flooding, to mitigating extreme heat and the impacts of, increasing temperatures. So, for us at the end of the day, the top priority is making sure that it is clear that there are things we can do on the ground to reduce risk, but we have to be very intentional about that and how that's done.
So give us some examples of the things that you're talking about here.
Yeah. So, I mean, maybe stepping from a kind of a state policy perspective, I think in California, we have made a lot of progress of elevating climate resilience and adaptation as kind of a co-equal to our emissions reduction agenda. When we talk about what it means to lead on climate, we are now much further along in advancing on adaptation and resilience. I think we are still in a place where we have not, and this has been one of the things that has been a driver for some of the work that we've been doing in partnership with Insurance for Good. But we have not, I think, gotten to a place, and it's not just in California, but kind of collectively, where we're really thinking strategically about how to align investment in long-term risk reduction. And I think there's a couple reasons for that. One is going back to the risk ownership piece. I don't think we have quite mapped out and have a handle in terms of the important role of kind of public backstop, but then where and how we use public dollars and direct public subsidy versus where we need market shifts to change. So, for example, on the insurance side, one of the things that we're really focused on is how do we get insurers as an important piece that you well mapped out in terms of kind of a important piece in our economic system to better and more consistently recognize investment in on the ground risk reduction that's happening, because that's how insurance is going to send the signals on the value of those investments. So we really need to think more strategically about where and how we're spending limited public dollars on the upstream risk reduction, but then also couple that with actions across the insurance industry to value and recognize those investments. And I think the other piece that's important for this conversation, and I know we're probably not going to spend as much time on it, but it is an important part of this ecosystem. I think we need alignment across how capital providers are also evaluating and recognizing the value of investment and risk reduction, as well as rating agencies, because they all play really important roles in sending aligned signals. And right now, those signals are kind of all messy and complicated. And I think last thing I'll just say here is one of the things that we're really focused on in this work is being much more precise about and using in our decision making about how and where we're making investments. Are we subsidizing risk reduction, not subsidizing risk? Because if we are subsidizing risk, we're also interfering with actually incorporating the real costs of climate in our economic systems, which we need to do. But then we need to think about how are we driving public investment to make sure those risks aren't causing shocks into the system as we're pricing, and also guiding a transition to risk reduction, especially for communities that have limited access to capital and or have been shut out of kind of economic opportunity. So I'll stop there. Happy to kind of dig in anywhere else, but back to you.
Yeah, no, I think what some of the things you brought up are really, really important, and that is the fact that, you know, risk and the damage that is caused by an event is a result of multiple factors. It's not just the fire, it's how protected you are against the fire, how vulnerable a property is, or hardened a property is against the fire. So there are things that we can do to change our exposure to that risk or how that risk hits. Right? You know, we can try and change and address climate change. We're not entirely doing that now. So if that continues, then we will face these risks. And so how we adapt, and resilience and adaptation is important. The other thing I think that's really important is this: how risk is a fundamental driver of value, and it's the value of everything. It's the value of you know, our houses, the things we eat, our entire economy. And if we subsidize risk, if government covers that risk, you know, you get all kinds of interplays with things that economists call moral hazard, right? Like if your risk is subsidized, you take more risk, and the costs increase of that, right? And so how do you not subsidize the risk? How do you subsidize, as you well put it, you know, the risk reduction and addressing the risk? I think it's interesting that California has a FAIR plan, right? It has an insurer of last resort, where if insurance leaves the state, you know, California, the state itself takes it up. With the LA wildfires, that insurer of last resort almost certainly went bankrupt, right? Like it probably can't cover what it needs to cover. So, you know, what does California do? It probably ends up raising rates. So, you know, the way risk plays into things like inflation and the value, I think, is super important. How do we get out of this mess, Nuin-Tara? What is sort of your thinking on what's the answer?
Yeah, well, I mean, just quick, and going to the FAIR Plan as an example in California, the FAIR Plan is actually, it isn't a state-run program, but to your point, it is managed, and it acts as this insurer of last resort. And as you were mentioning, kind of the insolvency issue, potential insolvency issues coming off the LA wildfire, is an example of the type of financial, but then also contagion risk that we can see through our economy through those types of things. And I think what we need to do, and just as an example on the FAIR Plan, coming back to that, what we need to do is make sure that we have got sustained investment in long-term risk reduction that is aligned and strategic across the state. Right now, we are not in a place where we have kind of consistent investment from the state in long-term risk reduction, partly a product of kind of the state's general budget volatility. And we've been dependent on a very volatile general fund, which means when there's revenue, we have money on hand to support grant programs. The challenge is that we can't one-time grant our way to resilience. We have to be thinking more strategically about long-term sustained revenues and risk reduction at the state level. We also need that at the local level. And I think as we're seeing the kind of federal context and kind of retreat in terms of federal investment in the upstream risk reduction, that's putting even more pressure on state and local budgets to try to fill that gap. We will never be able to backfill the federal government, and we still can be much more strategic about making sure we've got that sustained investment in upstream risk reduction. And then going back to things like the FAIR Plan, just quick here, and then I'll wrap up, is, you know, I think there was a large attention on the FAIR Plan, as there needed to be this last year, in terms of how you kind of address solvency issues there. We cannot leave people who otherwise don't have insurance, who've lost their homes, in a place where they're not covered. But the conversation can't stop there. So one of the things that we're interested in is, how do you set the right targets for measuring progress? On the FAIR Plan, maybe the goal is looking at reducing the number of mortgage originations that have to go to the FAIR Plan because they can't find insurance in the private market. We want to depopulate the FAIR Plan, but to do that requires actually reducing the physical risk on the ground through much more strategic public and private investment.
Yeah, and I think one thing people don't realize is that when you have an insurer of last resort like the FAIR Plan, there's adverse selection at play, in the sense that the people who can't get insurance anywhere else, i.e. the highest risk people are the ones that end up on the FAIR plan. So the higher the likelihood that the FAIR plan has issues when things happen. Yeah, let's turn to Guillermo. Guillermo, you've been in the insurance industry for a good long while, and it sounds like, there's so much happening and so many issues as a result of kind of climate and environmental issues and environmental risk. Can you talk to us about where you see the insurance industry now, how you think it's dealing with these issues, and where the future might be?
It's a big question, but I would say, well, I agree with Nuin-Tara that I think the basic foundation for improving our situation is risk reduction, right? Or risk avoidance. I mean, sometimes we talk about climate triggered retreats, and nobody, that term is not very popular, but it is happening. It is happening because we see that in some areas of the US, people cannot get insurance, so they're selling their houses, sometimes at a discount, and they're moving elsewhere. So that retreat is de facto happening in some places. But if we want to maintain our communities, we need to reduce the risk. I think it's important also to think of risk not as a uniform blob, but as a tranched and strategic, puzzle of elements. There are risks that we can tackle better than others. There are risks that we can split between different parties. There are risks that we can mitigate against more effectively. So I think it's important to think of risk as a conglomerate of pieces and attack them in parallel, right? So I think in the insurance industry, but what I'm seeing different reactions to this problem that you described at the beginning, which is very real. I mean, some insurance companies are leaving some areas. They're reducing the number of products that they sell. They're raising prices. So that all of that is happening. At the same time, we're seeing some new products into the market, and by no means I mean to say that these type of products are the panacea, but things like parametric products that are still showing high potential but unrealized. These are products that pay much faster, pay much more transparently. They're imperfect in many ways, but they're a device to complement current insurance coverages that I think have a long way to go
Yeah.
and to develop.
Just
So
on that
yeah.
point, just to give a clarification on what parametric insurance is. So parametric insurance, unlike, your traditional, say, fire insurance or property insurance, which says, you're insured for this amount, and then the event happens, they go in and see, do you qualify for insurance, and look at it and everything. Parametric insurance is much simpler. It says if wind speeds hit a certain level, the parameter in this case, then we pay. If they are under that level, we don't pay. So these are things that can actually be seen and judged, and therefore much easier. There isn't that whole process of going in and saying, did it happen? Were you affected? Should we pay? How much should we pay? There is really, if the parameter gets hit, we pay a certain amount, and if it isn't, we don't. So it's a sort of on-off switch, right?
Right. And many times we talk about the advantages for insureds, right? For the client. And these are the ones that you mentioned, right? You can pay fast, you can pay transparently, all of those things, very true. Less often do we speak about the advantages for the party that is insuring, that is putting the capital at risk. These parties also love parametric insurance much better than indemnity, right? Because for them, it's much more comfortable to deploy their capacity based on some number that they can measure with confidence, right? They don't have issues, in insurance, we talk sometimes about issues of trapped collateral, meaning that, in cat bonds and securitized investments, you can put some money at risk. But it takes time to determine whether that money should be paid out to the insured after an event occurs, after an earthquake or a hurricane, because we need to do the claims adjustment process, and that can last for years. So for an investor to have their money trapped in a in a cell, right, for years without knowing if they're going to lose it or not is a big problem, right? They're reluctant to enter in those transactions. So parametrics are seen by the investors, by the insurers, as a way to deploy capacity more easily. If that is true, then that means that parametrics is yet another avenue to attract more capital into insurance. And that is good news, because the more capital we have in the insurance business to operate, the more stable the prices will be, right? So I think that's an important element. And also the last thing I'll mention, Ricardo, for this first round is that you talked about where the future lies, and we're seeing also a lot of innovation, not really innovation, but the recovery of old concepts in the insurance space, in the mechanics of the insurance companies, right? So people are starting, we ourselves are exploring one particular mechanism, but people are going back to the old concept of pooling, right? Which is, the origin of insurance, right? If we all band together and one of us has a loss, then we use the money that we have contributed to together to pay that loss. And then next year, when something happens to another person in the pool, then we use that money. But basically, we rebuild that pot of money together. And by doing that, we split the risk, right? It becomes a more stabilized, we are more, it's more probable that we will lose a certain amount every year, but these amounts are smaller, right? So we shave our peaks, which is what insurance is about. So we're seeing a return to those concepts in a more pure fashion. Of course, insurers do that, right? That's their business. But what we're seeing is now the formation of more mutuals, more reciprocal exchanges. Just in the last couple of years, we've seen an explosion of reciprocal exchanges. Reciprocal exchanges are associations in which people sell insurance to one another, right? The mechanics are a little bit more sophisticated than that, but basically that's the essence. So I think that's great, because going back to the comment I made about tranching, if you go to an insurer and you say, hey, insure my house for all this stuff that can happen, they're going to say, look, yeah, we'll insure you, but it's going to cost you this amount of money. And if you want to reduce that premium, you can ask the insurer to, increase your deductible, right? Look, I don't want you to insure me for, the $1 million that cost my house, but I want to get insured by you if my losses exceed, let's say, $300,000, right? But then what do you do below that level? Well, below that level, maybe you participate in a pool with other neighbors, with other cities, and that allows you to control the pricing in that layer a little bit better, right? And even if insurers leave and they stop selling the product, you can still access that because you have control over that product. That's a product that you have designed with your neighbors, your community. Below that, you can also access, mitigation, reduce the losses, like the bottom layer, try to get rid of it, right? So by innovations in the products and innovations in the mechanics, I think we can advance. Will it be enough to, avoid a potential crisis? I don't know, because these advances are not happening fast enough, in my opinion, but they are slowly occurring.
Yeah. And I think it's interesting that you talk about pooling and alternative approaches here, because, in many ways, the story of insurance is a story of coming up with these different systems. So some people don't realize that insurers themselves take out insurance, and that's what a reinsurer is, right? Like the biggest reinsurers, Swiss Re, Munich Re, are some of the biggest asset managers and some of the biggest investors in the world. And what they do is spread risk globally. So, right, like if you're insuring in LA, if you have a thing like LA wildfires, it hits everybody. So the entire pool gets drained, right? Like, but if you have a reinsurance with a reinsurer that insures not just LA, but Singapore and, Tokyo and Sydney, well, that risk gets spread. The pool is widened. I'd also love to, you mentioned cat bonds, and I think a lot of people don't realize that that's another area of innovation happening in insurance, sometimes called insurance-linked securities or alternative risk transfer. These are financial tools that serve to some degree as insurance. So the way some of these work, for instance, is say they are a bet against something happening. So an investor says, you know, I will set up a fund to raise money to essentially pay you if an earthquake happens. If the earthquake doesn't happen under certain terms, then, you know, we keep the money and, you know, you pay the premium and we keep the premium. So in this case, it's not a big insurance company providing the coverage. It is investors who are pooling that capital that are providing the coverage. So there are, you know, catastrophe bonds, are the cat bonds is one example of this. Can you talk about these newer mechanisms? Do you think they have a role in addressing climate or environmental risk in any way?
Yeah, absolutely. Well, I sometimes don't count them as new because they've been around since the 90s. So, but they're relatively new, and you know they are a way to turn an insurance product into a security that can be purchased by investors, right? That is the trick. And the great magic that happens is that we increase the amount of capital that is available to insure. And that has been a revolution. I mean, that has been a great you know, it started being microscopic in the reinsurance market, but now it's pretty significant, the amount of money that we see coming from investors to participate in the insurance market, right? So that's great. There is one so that I would say that's their biggest, you know, contribution to solving the conundrum, the additional capital. But this year, you know, something happened this year that is truly innovative, and even though it is small, but it's a good sign, and that is that resilience element was put into a cat bond for the first time in history, right? This resilience component was for the North Carolina Association, which is a pooling system for insurers in North Carolina for the state to resist the impact of very, very large losses in the state. And all the insurers have to participate, but they also buy a cat bond to protect themselves for that tranche, right? That layer that is catastrophic, very, very high losses. And their argument was, if we don't lose the money, right? If the first year, I think it's a cat bond for I think it's 3 years. If we don't lose the money in the first year, we're going to take a portion of the money that the investors are putting in, and we're going to invest it into fixing some houses, right? Reinforcing them, building better windows, better roof, better envelopes of the houses so that they become more resilient. And by doing that, what they're effectively doing is they're reducing the risk for years 2 and 3, right? Which the investors like. So that is a concept that you know, had been published several years ago, but had never been taken, you know, with gusto by the industry, for good reasons. There was much interest to do it, but there are lots of obstacles to do it. The calculation of the risk reduction, for example, is a big, huge issue, right? If somebody says to an investor, if an investor is putting $100 million on the table, and you come in and say, hey, if I fix my house, your risk reduces by 10%. So give me a discount on the premium. The investor is going to say, "Whoa, hold your horses for a second, right? What guarantee do I have that the fixes you're doing to your house are going to reduce my risk?" And answering that question is very, very difficult. This is the first time in my knowledge that such a conversation has been successful, because it has been argued based on analysis done by the Institute for Building and Health System, I think is the acronym, housing systems, that this impact of mitigation could be calculated and embedded into the cat bond premium computations. So that's a big deal. It has gotten quite a bit of press, and for good reason. That's a very good positive sign.
Yeah. So there's a lot of innovation too in terms of nature. So there's been some parametric insurance products to rebuild coral reefs in Mexico and other places as a result of hurricanes. So nice to see innovation. And sort of speaking of innovation, let's turn to you, Elisa. You're entering a market and an industry that is right now in some serious flux and some serious shifts where, regulation is difficult to say the least, because few people realize that, we don't regulate insurance federally, that insurance is regulated at the state level. So there are 50 insurance regulators in the United States, many of them approaching things very differently than their neighbors. So it's a difficult market to be sure, but talk to us about why you decided to enter it, why you think it's important, and how things like future proof you think could change the industry and change the trajectory of where things are headed.
Thank you, Ricardo, and thanks to Guillermo and Nuin-Tara for their thoughtful comments. I think, well, so I started my career working with you, actually, Ricardo, doing this infrastructure project finance, right? And in these contexts, we were mostly focused on like decarbonization, and initially at least, like, oh, if this building owner invests X amount to make their property more energy efficient, it was relatively easy to show them. And then here's how much energy you'll save. So therefore, you should make this upfront investment of 100 grand because you'll be saving, whatever it's going to be, 20 grand a year, indefinitely. So it's a good investment. That works well for things like decarbonization. But when it comes to adaptation and resilience, the kind of economic loop doesn't work. Property owners may or may not make these investments to make their properties more resilient. But the sad truth is that by and large, the property insurance industry lacks the tools to be able to account for those very property specific improvements. And this was kind of a shock to me when I started Future Proof. But the fact of the matter is the industry by and large, and Guillermo, I welcome you to weigh in on this as well. By and large, the industry, not taking into account this kind of innovative exceptions that Guillermo might be talking about, this cat bond here, parametric there, 95% of the industry runs on these very standard catastrophe risk models for underwriting a typical indemnity insurance policy. And the problem there is that the industry relies on these very coarse grid systems to account for risk. And we're talking about like zip code level stuff here. Zip codes are very prominent in the world of pricing property insurance. Everyone from an underwriter to an actuary is looking at risk at a zip code level. And there are historical reasons for that around like the development of the use of zip codes by the US Postal Service. And when the insurance industry decided to essentially computerize in the 70s, they just sort of took up the zip code as a unit of measure that was already available and free. And so what we have today, though, as a result of all this, is still a system where, exposures are tracked by zip code. Everything's kind of done in this very coarse sense. And there's nothing wrong with the zip code per se, but it doesn't really correlate to where risk is aggregated or anything around risk and exposure. So the challenge is that what we have today, writ large, is a situation in which in a given zip code, somewhere in your neighborhood, maybe Ricardo, in the beautiful Bay Area, there might be two exposures in that same zip code. If that zip code is rated, say, the highest category wildfire hazard zone, it doesn't matter how resilient one property has become. You could have a property that's followed all of the IBES rules. They've got like 100 feet of defensible space. They've got modern sprinklers. They have fire resistant roofing. It's concrete construction, all that great stuff. Despite the very different risk profiles of like, say, the very resilient home and like the shingle home a mile away, if those two homes are in the same zip code and models in the industry show that the aggregate potential losses for that zip code look bad, there's going to be a binary yes/no decision for that whole zip code, essentially, where even the good risk, like the guy who's invested in all that good stuff, they're still not going to be able to get insurance. So I think the challenge that the industry faces, the mainstream problem, is that the models that the industry has been relying on to price risk, the combination of those CAT models with the subjective judgment of human underwriters, which is how the industry runs today, it just doesn't work at a granular enough level to really capture asset level resilience investments. And so now we have our status quo problem, which is that, we're trying to figure out how to motivate investment in risk reduction, But the challenge is that even when folks invest in those risk management, techniques, sometimes they still can't get insurance, or maybe they've invested a lot and there's just a standard like 5% discount they get no matter how much that particular activity might have reduced the risk for their home, because the industry doesn't necessarily have the technology to price in that very granular way. So it's, that's a problem that we at Futureproof have decided to tackle head on. We built essentially a model that we trained using AI on a bank of millions of insurance claims and policies. So we kind of really want to try and attack that. Like, hey, is it possible to build a model that could take these individual property features into account in the pricing? And so that was sort of where we started with our company. It doesn't make it any easier, by the way, for us to succeed as an insurance technology company. The fact that we get the price right more often than the industry standard models, it still is very hard, as Guillermo can attest to this. Like, the industry is very hard to enter for a whole host of reasons. But the bottom line is that we believe that's where the future of the industry needs to go. It's really relying more heavily on data science to be able to get more granular in pricing the risk. And the purpose of that, at least for our company, is so that we can be the entity that closes that loop, so that we put ourselves in the position in the future of saying, hey, property owner, if you make these improvements to your property, we Futureproof will guarantee here's how much your insurance cost would go down. And we want to guarantee that for more than 1 year. So now, Guillermo, you may have, I'd love to hear your responses to that, and Nuin-Tara as well. But that's kind of what we're hoping to do with our model, is really bring some of those principles from infrastructure finance, energy efficiency finance, and bring them over to the world of climate adaptation and resilience. But it all starts with having the data and having the model that can account for those very granular property features and do so in a way that's very robust from a data science perspective. So that's kind of what our mission is, what we're trying to do. We launched in August 2024, writing mostly small commercial property insurance in the Southeast, things like hotels, motels, gas stations. And now we're getting ready to stand up a few new programs, including a California homeowners program, Florida homeowners program, and then a renters program in several states. So we are on our way. We're still just an infinitesimally small drop in the insurance bucket for property and casualty insurance companies, but we do see the way forward as really leveraging AI so that the industry can better price the risk in order to help motivate investment in climate resilience. So I'll stop there.
Yeah, I mean that's super fundamental, right? Because as we were saying, risk is a really important driver of value. And if we're not having that signal going to the market and saying, having these hardening effects has value and this is the value, we're not encouraging that kind of investment in it. I guess, how do you deal with some of the other issues, or do you deal with it, or do you think we can deal with them? Some of the other issues around models out there, right? One being that, the past may not look like the future in many ways, and that we may have our risk models wrong. Do you think that's a problem, or a big problem, or not a problem?
I mean, there's so much there to unpack. It's like, I mean, I don't know if you guys all saw the news even in the past few weeks, So Futureproof started off as a climate risk analytics company. We thought we were going to sell analytics to banks and property developers and to the multiple listing service, just 6 years ago. But it turned out that a lot of those entities did not want to know sort of what our projections for climate linked losses to a particular asset would look like. And so I just I've been following the trajectory of, these property listing services like Zillow and Redfin. They kind of gradually started adopting more and more information around climate risk for properties because people demanded it. They wanted to know. But on the other side of that is all of the science and the challenge around predicting, the risk. And anyway, just in the last week, Zillow decided to stop including, I think it's Matt Eby's company. What's it called?
First Street.
Thank you. First Street. Stop including the First Street kind of data feed because it was too controversial. And real estate agents were mad because it was preventing them from being able to sell properties, because if the First Street data shows that there's like a 1 in 10 chance of this property flooding every year, nobody wants to buy it.
Yeah.
So all to say, I think it's a very fraught issue.
They were mad because it was working, because it was actually
but
translating
actually,
to value, right?
I think it's actually more complex than that. And I would welcome Guillermo and Nuin-Tara, who I'm sure both were following this story as well, to comment. But like, I think it's actually more complex than that because the the data quality also matters. And, yes, First Street's data is eons better than the FEMA like flood maps. That's great, but that's a super low bar. The FEMA flood maps are known to be like not very good at all and like grossly underfunded, perhaps more now than ever. So the truth is, do I think all the First Street data is perfect? No. Am I sure there are lots of properties that we're showing as being more or less risky than they really were? Yes. So is that a problem? 100%. Is there any model out there, and Guillermo, you can answer this one much better than I can, that could truly be accurate all the time? No. So is it better? Anyway, so this is it's a political question of like how much data people are entitled to have. A lot of states have some, disclosure rules in place. Like in California, you have to disclose, is this within a wildfire hazard zone? Are you in a flood zone? But it's, again, state by state regulated. I do think there is a lot of uncertainty in the system itself around predicting the average annual loss. Obviously, the industry struggles with this. We're trying to move the ball forward in our own way with our own model, but there's no perfection out there available.
Yeah.
So
Yeah.
I'll stop there because I think probably.
Yeah, no, I'd love to hear Guillermo and Nuin-Tara's thoughts on this as well. We do have some questions coming in, and if you want to type in your questions, we'll try to get to them, although I know time is running out, but we'll at least try to get to some of them, put it that way. If not, we'll type them in. But before we take any questions, any thoughts on any of the above from you guys, Nuin-Tara, Guillermo, or anybody else?
Yeah, I would just kind of where Alyssa, your last points around kind of the data and this question on kind of the information that we need to really be making these decisions. I think, yeah, there's a wealth of data out there. I think part of the challenge in this context too, and why it is so complicated, is just having the data alone doesn't solve some of the other issues like accounting and some of those incentive issues that we've been talking about here. And I think there's two that I see as really important that we need to be focusing on, which is one, even when you understand the risk profile, say you have property level data that you feel like is reliable and accurate and timely, actually turning avoided losses into cash flow when future losses are not tracked on balance sheets is an issue. And so in my mind, that is like an accounting issue. We haven't quite figured out how to get the data and information that we have when we do have it actually into our accounting system in a way that, needs to mature and kind of be, changed based on us living in a very different, climate world than, kind of stable, reliable, historic data. So I think that's one. The other is, and I'm curious thoughts on this, is I think one of the other challenges that we have kind of similarly is preventing something from getting worse also doesn't show up as savings on balance sheets and in cash flows. And I think this is an area where we see a lot of need for continued clarity and distinction too, because I think there can be a little bit of confusion of like price. Maybe we are living in a world where price stabilization is actually success. Price reduction may not be feasible all the time. And our systems, and Alyssa, you were talking about this too, of like being able to show premium reduction or price reduction from investment. Where that can happen, that's great. But sometimes actually just price stabilization might mean we're doing our job well. And I think some of these like standard kind of accounting incentive systems haven't caught up yet to the new climate reality that we're in, even when we've got great data available and information around risk. So I think there's another layer that we need to kind of figure out, just building on, what you all were talking about.
Yeah. No, and it's also interesting that, if you look at how insurance is regulated in many states, it really is about premium prices because these are political appointees in some cases, and there's very political processes that say, all we care about in regulating insurance is that premiums don't go up. Doesn't matter what the risk is or whether they should go up because the risk is increased. We're not going to let them go up, or we're going to push insurers not to raise premiums. So, there is that potentially problematic connection between regulation and pricing. Guillermo, any thoughts before we take some questions?
Yeah, I just wanted to comment a couple of things that Alisa mentioned, and Lisa, I totally agree with you. I think the models that we use today are imperfect, insufficient. In their defense, because I guess I've had a 20-year career in this world thanks to models. So. There's a very big community now of engineers and scientists working in the insurance industry, and it's because of these models, right? Before it was, the field was dominated by actuaries, right? Whose job was to parse through the historical data that insurance companies had to find patterns. But in the 80s, two pioneering companies at the time. Now they're still the big behemoths, let's say, in the market, RMS and NAIR, now Moody's for risk. They came up with this research that was very new at the time. I mean, the hurricane modeling science was developed at an insurance company at Travelers in the 70s, right? So these companies, and then in parallel, there was a lot of great work being done in California by Alan Cornell and that team at Stanford to model losses from earthquakes, right? This is happening more or less at the same time in the 70s, early 80s. And out of those separated efforts come these two companies, right? One in California focused on earthquake, one in Boston focused on hurricane. And they developed, these numerical simulations whose job was to fill in the gaps that we had in our data sets, right? Imagine, I mean, a Category 5 hurricane happens in the US, once every many years. So the companies didn't have enough data. So these simulations were a device, and it was thanks to the rise of computers, right, that we could do these simulations. These simulations allowed us to fill the data set. Now, in going again to your point, Alisa, what was the origin of these models? Well, it was to represent the current state of affairs, right? How can we model the physics of the world we know today? And that was the job, right? And also bear in mind that the policies that we're modeling year on year they have a 1-year lifetime, right? We model every year for 1 year. So we were looking always for a representation of what happens today. Now, are these models fit for purpose for modeling what could happen in a future state of the world? No, and this is giving rise to new models, right? Like the ones you're building, Alisa. There's several other companies looking at this problem. AIR and RMS, well, Verisk and Moody's have over time also developed their own, climate sensitive catalogs and so on and so forth. So the models have a lot to improve. Also, the resolution that you mentioned, totally right. Also, these models started in the reinsurance industry. The reinsurance industry does not really care about whether one property on one street or the neighbor or the person in front has losses or no losses. They care about aggregations, right? They care about how much loss are we going to see in Florida this year, because that's the basket of risk that they're trading. So these models were from the very beginning targeted towards that layer of the market, the very aggregated. And for that, they were a fine estimation. But now, if we want to translate those models into property-specific values, we hit several barriers. But one of them is of a scientific nature, like the uncertainty that we have on the physical processes that we're trying to model is so huge that it doesn't make sense sometimes to try to predict or to estimate risk to a property-specific location. It's just it just doesn't make sense because depending on the risk that you're talking about, right? But the uncertainty bands are just too large based on our knowledge. Will that improve? I think so, but that is a difficulty that is still very present today in all insurance operations.
Yeah. So, conscious of time, I know I can stay on a little bit longer to see if we can answer a few of the questions that have been posed. I don't know if the three of you can stay on a little bit to do that. Does that make sense?
Again.
Yeah, great. So let's start with you, Guillermo. There's a question from Ned Abelson that says, how is pooling different from reinsurance, which reinsurance companies already widely use, or which insurance companies already widely use?
Right. No, the concept of pooling is the same, right? I mean, insurance is pooling, really, is aggregating risks from many so that you get fewer spikes, right? So that is the law of large numbers, if you want to go back to basics. So it's not different from that in that aspect. It is different, though, in the level of control, most importantly. So, you know, you all and myself here, we don't have any control over the reinsurance market, right? It's several layers removed from us. So if the prices go up or down in the reinsurance market, and by the way, the reinsurance market is not regulated, so they can increase prices, drop prices, they can do whatever they want. There's nobody regulating what they do. But the insurers are subjected to these swings in pricing, and the insurers are regulated. So the insurers cannot say to the regulator, hey, the reinsurer just increased my premiums, I need to increase the premiums for my insureds. That tension is very much there, and it requires a lot of finessing between all the parties. So by the concept of pooling that I was mentioning before, what I mean is that we can increase our control over our own pooling activities. That means that before I go to insure myself, right, layer one, let's say today, I don't pool risk with anybody. I just go to an insurance company. But if this insurance company doesn't sell me a product anymore, or I'm very unhappy with the products that I see out there, and there's no product that fits my needs, then I'm gonna go, in quotation marks, to my neighbors, and I'm gonna tell them, look, we all share this risk. Nobody wants to insure us. Why don't we pull together our risks and come up with a mechanism to protect ourselves a little bit? So now when we go to the insurer, layer one, now layer two, we say, we don't want you to insure our full risk, just a portion, because we're going to take a chunk of that risk ourselves, right? And then the insurer does the same, right? They have their own resources, and then they go to layer three, which is the reinsurance. They can say, we don't want all these risks. Yes, we want a reinsurer to pool U.S. earthquake with Florida hurricane, Japan earthquake, floods in Thailand, and by pooling those risks, the reinsurer makes money, right? So it's not a novelty in the concept. The concept is old as beans, it's innovation in the level of control, I would say, and even that is not new. It's just a return to the origins.
Yeah, it's a bit of a back to the future. That's how most mutual insurance companies were set up, right? Like
exactly
with those pooling mechanisms. I think there's also probably another layer somewhere within those three layers, or a meta layer, which will be the actually insurance-linked securities, right? Like
yes,
they will take some of that risk themselves as well in alternative risk transfer mechanisms. There is a question for you, Elisa, asking, how are you working with governments to adjust how they regulate the insurance industry in light of the data that you provide?
I mean, so we're a venture-backed startup. So I guess what it really means, sadly, is that we don't have the time to engage with governments on this issue because it is a multi-year process. We essentially focus mostly on the excess and surplus lines markets. So that's where you go if you have trouble getting insurance. You're a broker, whether or not you're aware of it, your insurance broker, if they can't get a quote for you easily, they're going to start asking around in the E&S lines. Excess and surplus lines are generally not very regulated. So that is good for us because there is a process through which, and I think Zesty went through this to get their model approved by the California regulator. So it's not that it's not possible. It's just a bandwidth issue. So Zesty had a new model for modeling California or wildfire in general. They wanted the insurance industry to be able to use their model, so they went through the process to get the California regulators to approve the Zesty model for use in pricing property insurance. And that was like do or die for them. But in our case, while there would be benefits to us, of getting the regulators to be a little more open-minded about newer models, it's for us in the near term, our main focus is just to launch in the E&S lines where we can use our model and price freely. E&S lines are growing rapidly since it's really hard for a lot of folks to get insurance. So we have like a niche there that we can focus on in the near term where we're not necessarily hiring lobbyists or spending a lot of our staff time trying to convince any government officials to do anything in the near term, to be totally honest.
Okay, well, we should probably wrap up. Before we do, I would love to do two things. One is there is one really interesting question out there as well that I'd love somebody to take and not too long. And that is, how do panelists think about the role government should play in the provision, vetting, distribution of climate hazard data and models? Currently, it seems like the burden is falling onto the public, like a typical home buyer, to educate themselves of company model differences and to decide which company's model is trustworthy. So, what is the role of government on all this? If anybody could take that. And then to close it off, I would love to hear from each of you one thing that you would like to see happen in order to make this future that we're facing, climate, environmental risk future, a bit better than it currently is in the trajectory. So I don't know who wants to take that question quickly.
I can take the question quickly here, which is one that is also near and dear to my heart because when I was with the state of California, I worked on our California climate change assessment, and I think California stepped in, and has is a state that has invested in publicly available downscaled climate modeling and data, and has then done, made significant investments to then try to provide that data and information available so that there is a public source for this information that then, private companies, utilities, different entities, local governments can then use that. They can hire, firms, consulting, additional capacity to help them understand, but everybody has got access to, vetted, downscaled, relevant data that are available that actually does lower some of the barrier and provide some accountability to one of the questions that was there, part of this question of like providing some guidance and direction on how best to use those data and information in decision making. And I think the public sector has a really important role in kind of democratizing and providing that data and information out there across communities, and then people can do their own analysis and bring on additional kind of interpretation. But I think that's a really important role, and I think that has been part of kind of California's leadership on climate, is really recognizing the important role of sustained public investment in that type of modeling and analysis to help support with building that capacity for other stakeholders who need to be using that.
And it's super important because, as we talked about, government ends up holding a lot of this risk at the end of the day. So knowing what it is and understanding it is super, super important. All right, Nuin-Tara, what's your one thing?
Oh, my one thing. I think my one thing, and maybe I'll go back to kind of where I started, which is kind of a big picture view, is continuing to really frame and think about climate as a fiscal and economic issue. I think there's a lot of work still to do, and I just don't see how we actually drive investment in risk reduction until we are consistently recognizing climate risk as an economic and fiscal issue.
Perfect. Guillermo, what's your one thing?
My one thing is the deployment and streamlining and improvement of parametric insurance. I think that still holds a lot of promise. Of course, I've been working on it for many years, but I still think most of the promise is still unrealized. So I think in that little niche in the insurance space, there's a lot of really exciting and interesting and helpful work to do. So that's the area I want to dedicate more of my time to, and it will be wonderful to see that flourish.
Thank you. Elisa?
Cool. Yeah. And for me, I think the glimmer of hope is that there are so many like fascinating new innovations happening in insurance. And I think what the industry needs more than anything that can help really accelerate all of that is more brown graduates who are interested in data science working in insurance. The industry needs smart, young data scientists.
Yeah.
That is really, I think, one of the key things that's holding industry back. Is like old ways of doing things, old models. We need really hungry young people who want to get involved in this, like I would say, highly intellectual, high social impact sector of insurance.
So yeah, insurance is dead. Long live insurance, right? We're at that. Well, join me in thanking these wonderful panelists for giving us a really broad and sweeping and in-depth and deep survey of what's going on and how climate and environmental risk are really impacting insurance. And hope to see you all again in one of these future webinars. And thank you to the folks who helped put it together, Jessica, Lily, Kay, others. Appreciate it. Have a good day, everybody.
Thank you very much.
so much.
Great seeing you all. Bye-bye.
You too. Bye-bye.